Here are my 4 scalping rules that will help your account size grow. Okay, whether you have a smaller size trading account or a larger one, it doesn't matter. Watch the video to the end so that you can grasp and understand these 4 simple rules. You're going to want to get a pen and pad because this is going to be a great video. Let's go ahead and jump into it today. But before we do, I want to say thank you for everyone out there that's watching, that is part of the community. You know, if you join the Discord, which is free, the link is down in the description portion of the video. Or if you are simply an elite or an ultra elite member, I take my hats off and I thank you guys for supporting the channel as well. If you're interested in joining what I just talked about, the links are down below in the description portion of the video. Now, let's talk about these rules. They are very important. Rule number 1, let me share this with you. You have to get the direction of the market correct. Whether we are trending to the upside or trending to the downside, and we will look at the charts or switch over to the charts here in a minute and talk about it. But as long as the market is making higher highs and higher lows, which direction do you think that we should be trading? If you answer to the upside, you are absolutely correct. I trade a simple strategy surrounding supply and demand, okay, where I like to mark up a higher time frame, all right, or higher base chart. I trade using range bar charts, so that's extremely important to me. Now, if you trade time, tick, or volume charts, you can do the same. Supply and demand is universal. So what I do is I like to get the direction correct, mark up a higher time frame chart first, and then scale down to a lower base entry chart to take my trade from. I'm not taking my setups from a higher time frame chart. Why? Because the simple fact is that I'm a scalper. I love, simply looking for quick moves in the market. I'm in and out within 5 minutes. I'm not interested in swing trading, holding trades for an entire session or for several days. I'm only looking to pick up or take 1 to 2 quick trades, setups a day and be out. All right. I'm telling you, it works day in and day out where you can become profitable and make money every day. That's the goal, is to be green on the day. So again, rule number 1, the market structure. If we look at the chart, for example, here, this is my 120 higher time frame chart. We can clearly see the market is doing what? Making highs, higher lows, highs, got a nice retracement here, and then broke structure above here, pushing higher. As long as we are continuously making higher highs and higher lows, breaking structure, then I only want to be looking for what? For key areas of demand to take trades going back to the upside. So if you take a look here, we were bullish. This was yesterday's trading session. This is which was Monday. This is Friday's trading session right here. We were breaking structure to the upside. The market pulls back to a nice area of demand, roughly about 1245, 1240, somewhere in the area there. Demand right here. Now, why is that clearly a demand zone? Because we are breaking higher and taking out areas of structure. This is a major high. And you have to understand, which is the next part of the rule that I want to talk to you about, is identifying and knowing the difference between minor and major areas of structure. If this is a major high resting right here, and then we get a nice retracement to the downside here, you're going to have pivotal points or highs in between a leg that will be basically minor areas of structure. So you should be able to determine with your eyes to be able to see where's my last push to the upside where the market was breaking structure, which is my last high. And then when the market starts to make lower lows and lower highs, where are the high points within this leg right here that I can mark off to be key areas of structure as well. But they're going to be classified as minor areas of structure because this is a major high. So let's talk about rule number 2. Okay, we already know that we need to get the direction of the market correct first, and that's going to depict which way we need to trade. So when it comes to major and minor areas of structure, look at a leg, whatever which direction the market is moving in, and it makes its final attempt or its final approach, and then it starts to move the opposite direction, like right here. This was from June the 11th. This is a major high, the last high that it made before it started doing what? Making lows, lower highs, lows, lower highs. Down to the downside, you can see it breaking lower, right? So with that being said, what you want to do is identify your last high. That's the major high. Everything else in between are going to be areas of minor area structure, okay? So we'll go ahead and mark this off right quick. Let's get an arrow line right here. And we can see this is a high, okay? Market comes down, breaks structure to the upside. Here's a high right here, okay, as you see, but the market came down and broke more structure below this low right here, so it made a lower low. So then this will be our last high that it made on the push up to the downside before breaking lower right here. Okay, can you follow me right there? And then it makes a pullback, break structure to the downside right here, as you can see. And then this is a pivoted point where this could be a high right here as well, where we've got our final low. So these are some minor areas of structure right here back to the upside, to where the market can, when it does start breaking these areas back to the upside, you can look for key pullbacks to actually go long. That's why I have this area right here, which was a demand zone marked up, because when the market made a higher low, we got a bit of consolidation. And let me help you with this when it comes to, the pivotal points where the market is shifted lower and then we start to make our ascend back to the upside. Look for the market wherever it makes its last point at, okay? Look for an area where it starts to consolidate. So if we look back up here at the tops right here, we had this high, right? Middle low, lower high. So it's consolidating in this area right here because it's not breaking above this high right here. Then we get another low to the downside right here, pulling back again. So we know at this point where it's made the first lower high and then a second lower high that we're not going to probably more likely be pushing higher at this point, because now we're running to the downside, making lower lows and lower highs. So that's our major high, okay? And now we have these minor areas of structure in between a major high and a major low, this being the last stop, okay, last place that the market stopped at or halted at before it started making its push to the upside. So what you're going to be looking at really see is where the market starts to reverse or starts to move back in the opposite direction, we may get a bit of consolidation. That's a telltale sign that, like right here where they made a higher low, and they're not breaking below this low here, but it made this higher low, push back up, came right here, and we got another low right here, but it didn't break below here. This is a higher low right here, and then they make a new high back to the upside. So they gotta, wherever you have a bit of consolidation from the turning point where the market may have shifted from the downside back to the upside, that could be a telltale sign again where the market is starting to trend back to the upside. So now that we see a bit of consolidation here, and the market makes a higher low, let's look at some areas like the minor areas of structure. When they start to take out those areas of structure back to the upside, like this first area of minor structure right here, again, this is a major high. These are minor areas right here. So if the market starts to take those minor highs out, okay, then you can look for key pullbacks to areas of demand to actually go long. Or you can wait for just the market to fall through with more structural breaks to the upside, like right here. It pushed up. It took out this high right here. It pulls back, but this is a low probability area where there was demand at. So I'll wait for a clean setup to where there's a high probability setup. That's something I'm going to talk about in rule number 3. So we got a high, a higher low, and a break of structure. Okay, we got the consolidation at the bottom, the market making higher lows. It doesn't want to break and make any new lows. We've got the market taking out minor areas of structure, pushing higher, higher low, breaking structure, coming back to a clean area of demand right here. And this is where it's going to move, where we start to move to the pivotal point to where we talk about, rule number 3 when it comes to scalping these markets. These are the golden rules that you need to understand, all right? There's basically 4 of them that are going to help you, determine and get into high probability setups. All right. So what makes the difference or marks up the difference of a trade being high probability versus low probability? It's simply the imbalance resting back at the zone. Is there a gap in between where the market broke structure to the upside, say for example, higher low, aggressive buying, broke this area structure here, and the gap, people always ask this question, well, how do we determine, or where is the gap at? The gap is resting back at the actual demand zone in this case here, because we're breaking structure back to the upside, taking out minor areas of structure, okay? So again, think of minor areas of structure are in between highs or lows, it could be lows, or intermediate highs and lows in between a major high and a major low. Okay, so this is one large leg from where the market made a high, and now we got smaller highs as it's making lows and lower highs. You'll have smaller highs in between this leg to the downside here. Okay, because this right here, take a look. Market came down, pulled back, broke lower, pushed back up, and took out this small little high right here. Then it broke structure to the downside. So that marks up where we got a high resting in it, right? Because it broke above a small little high right here. Comes down, pulls back, breaks lower, pushes up here, okay, or retraces up, and it breaks above this high here. So now we have a high right here, but then what you see here is as the market breaks structure here, we started pushing back up and we took out this high right here, Okay, so now we got a new high resting right here. All right, right here. As the market breaks more structure to the downside, these are our highs that are setting us up for the minor areas of structure. Okay, same thing when we got down here at the bottom. We had a low, lower high, came down, made a new low, creep back to the upside or retrace. We got where it broke above this high, so now we have a new high right here before the market broke structure back below. So then now this is going to be our last high, which is a minor high, okay? Because these are highs or intermediate highs that are within this leg to the downside, okay? So moving on to rule number 3, again, the high probability setups versus low probability setups is only what makes the difference is if you have an imbalance or a gap resting back at your zone. Take a look here, just for example, if this was a structural break to the upside where we have aggressive buying, look, you see with that bullish candle right there broke above, this is the zone right here. This is the demand zone. Broke above that last down bearish candle to the downside. This one here broke above. Okay. So it made aggressive momentum push to the upside. All right. Then we're going to look at the very next candle that closes after that one. This one right here. How far back did this candle, which is basically like the third candle, okay, because this is the candle that broke above the last down bearish candle. This candle right here, how far back did it pull back? Even to the wick of it, right there. All right, so there's a very small gap on this candle here that broke above that last down bearish candle from the bottom end of that third candle back down to our zone. Very small gap right there. That's what makes it a trade or a setup itself being classified as a high probability zone. Now, if this candle right here, okay, came back with the wick of it and closed to the zone right here, all right, and then pushed up, that would be low probability because the gap's already been filled prior to it coming back, okay, again. So you want to make sure that you have a gap in between the zone and this candle right here, okay? So look to see whatever candle closes above that last down bearish candle if we're looking at a demand setup, and then the very next candle that closes above that one, how far back that wick of that candle or the candle itself comes back down to the zone. Sometimes they may come right here and leave a very small imbalance or gap resting back at that zone. So again, that's what makes or marks it up or makes the actual setup itself being high probability versus low probability. And I'm looking and entertaining 99% of the time, 98% of the time, looking forward to take high probability setups, areas in which the market needs to come back to and fill that area, because the way I always look at it is that there are probably orders still resting on the books that need to be filled. So the market makers or the banks, they're going to try to come back to those areas to fill orders that they have on the books that they need to place or, put into play, I should say. And we want to trade as retail traders those areas, okay, where we see the gap set on those high probability setups coming back to the zone, okay? Price actions, everything as well. You need to understand, what's taking place. Are we breaking minor structure back to the upside? Yep. Then that tells me right then and there that where we were bearish, now we're back bullish to the upside, and I can look for pullbacks to go long. Simply put, okay? Right here, this was a high probability demand zone. You can see the market swipe or came below the area right here. That's a liquidity sweep before they push back to the upside. So again, I just told you what the difference of what a high probability versus low probability setup looks like, okay? Based on, what makes it high probability. So that's rule number 3. Once we basically get the pullback to our zone, it's a matter of looking for the rejection, okay? Now, what I want to say is I'm just showing you an example, but I'm not trading it directly off of my higher time frame. This would be where I would mark up my higher time frame and then come down or move down to a lower time frame chart and look for an opportunity or a trade setup to actually go long. I'm going to show you real time in today's session. Let's look at an opportunity or a setup here. Like right here around 10, 15 area. Let's go down to the higher base chart right quick, up to the higher base chart. It's right here in this zone right here. You can see where the market was coming lower, right? So we got lows, lower highs, lows, lower highs, okay? Then it makes this high right here because these swipe above this high right here. So this is our most recent high when we started pushing back to the upside. Then it comes down and breaks structure below these lows right here. Then the market turns back around and we do what? We start pushing higher, high, higher, low, and then breaking structure to the upside. So this would be a minor high right here, with the market break structure. So there's a demand zone right here, okay, on the higher time frame. So I mark up that zone we have an imbalance there, resting back to the zone because this was a push up, pull back, broke structure, aggressive buying, mark the zone on the 120 range chart. So then I'll move down to my lower base chart, okay, my 24 range, and see if I can find or see if there is a high probability 24 range demand zone on the inside. So the larger blue box marks up the higher time frame, the zone, and the the smaller box here, the yellow one, that's the 24 range demand zone. So we have where the market pushed to the upside, as you can see here on the 24, and came back on the inside of the 120 range high probability zone, and there is a 24 range high probability demand zone as well. When the market comes back here, I'm interested in going long where I get the break and close above right here at 22,114. My stop loss is going to go on the back end here, roughly 22,109. I'll give it maybe 2 or 3 points breathing room there, 107, 106, somewhere in the area right there. Why is this a high probability setup? Again, because we have a higher time frame, 120 range, demand zone. We also have a high probability 24 range demand zone. This is multi-chart confluence where we have a zone within a zone. So I have a zone on the 120 and I have a high probability 24 range smaller time frame zone resting on the inside of the higher base zone. Okay. So that's multi-chart confluence. The more confluence that you have within or on your setups, that's what's going to help you take some of the best trade setups. We have the break of structure here, push to the upside as the market pushes higher, higher, low. Breaking structure, pulling back, breaking more structure when it wicks above these highs right here, and this is your demands on the 24 range to take your trade from. That's what I'm looking for. The rejection, which is rule number 4. When the market gets back to your zone, you're looking for the rejection. So I like to, again, mark up the higher base chart, zone, larger one. Mark up the lower base chart, which I'm going to take my trades from, my entry chart right here. Okay, the smaller box. When it comes back to inside the larger zone and the smaller zone from your entry chart, look for the rejection. Okay, that's rule number 4. Once you get it, the break and close of the candle above, you can go long here at 22,114. Okay, it's simply put, guys. I mean, it's not rocket science. It's not anything that's actually hard to do. It's very simple, and these 4 rules will help your account size continue to grow from month to month, week to week, year to year, and allow you to be consistently profitable. Is it going to work every single time? No. That's where you have to practice proper risk and trade management to know to either cut the trade short, get out the trade so that you do not incur any type of large drawdown so you can keep your account sustained so you can trade again the next day. Now, we'll give this as a rule of thumb as well. If you are trading, please, within your trading plan, hopefully you have one, you put a max number of trades that you are going to stick to each and every day, whether it's 1 or 2. When you start trading and over trading too much, that's when you start to kind of revenge trading because maybe you take a loss and then you're ready to get back in and try to make it back up. That becomes a vicious cycle and you blow your account. Whether you lose or win on your first or second trades, be done, okay? That's going to help preserve your capital, all right? So hopefully this video helps out. Hopefully it reached the heart and mind of so many traders out there who are watching this video. I just want to share these 4 golden rules with you that will help you continuously be profitable and keep your account size growing. Now, if you're interested in getting so much valuable information to where I walk you through trade setup at the setup, you might want to become either an elite or an ultra elite supporter or member here on the channel, okay? It's only pennies on the dollar a day. I'm talking about you can become an elite member to where you receive the trade breakdowns, my video playlist, and a great video I covered on market structure, all for $6.99 a month. That's all it is. It's like 24 to 25 cents on the day, okay? Now, you can step it up one notch and you can become an ultra elite member, okay, where you get the same thing, the trade breakdowns. There's tons of that video content there. And let me stop right now and say within the trade videos, what are they for? That's where I walk you through the setups. The ones that I post over on the Discord community, I'm walking you through as if you're sitting right next to me. We're talking about structure. I'm walking you through the setups from my mindset. I'm talking about and showing you the trade itself, where to place your stop at, where to place profit at, things so that you understand the supply and demand strategy and how it works as a whole and how I personally trade. Again, you also receive that plus the video playlist, the market structure video, and in addition to, you get the live recorded trading sessions. Yes, where I record my trades and I'm basically recording a full-on session of my trades, looking for 1 to 2 scalps, and then I'm done and I'm walking you through, and you can engage and watch me take those trades, and I'm talking you through the setup just as well. Okay, so you get the live recorded trading sessions and market recap videos where I go back. I don't do it every single day, but I do it several times a week where I would go back and do recaps of the video sessions. So I'm looking at structure. I'm talking you through, okay, there were other possibility or other areas of high probability setup that we could have taken trades from, maybe even in the afternoon session. So you get all that addition to for $14.99 if you want to become an ultra elite member. That's like what, 49.50 cents on the day. Very inexpensive, okay? Or you can go somewhere and spend hundreds of dollars or thousands of dollars for someone so called, course or whatever the case may be. But again, if you follow these simple things that I talk about that are added value, lots of value, and if you become an elite member, you can basically educate yourself. I'm telling you, we have traders that are part of our Discord community that are supporters of the group or either elite or ultra elite members, and they can vouch. You can even ask them on the Discord channel, but I'm simply trying to tell you that they trade similar to, they've converted and are trading range charts, and they'll tell you why they're trading range charts. They'll tell you why they're trading a strategy, because it works. All right. Outside of that, guys, and again, I can't guarantee anything when it comes to the strategy as a whole, because you have to be able to understand yourself and do the back testing and forward testing yourself. What I'm providing you is showing you how I trade. Okay. I share it with you. I provide all this educational information and just give you a backdrop of the trades and how my style and how I trade. Now, again, some people, they come from different worlds and they may try to mix and mingle and match one strategy to the other. Keep it simple, and that's what I try to do with the strategy. I'm not trying to overdo it. I'm trying to keep things as simple as possible, because supply and demand is universal. Like I said, it really, really works. And I'm just bringing to the table a very strategic and very simple strategy that works. All right. But outside of that, guys, that's really all I have to say. If you're not currently a subscriber already, please take the time to sub by clicking the sub button down below. Make sure to turn your post notifications by clicking that bell. And last but not least, drop me a like on the video if you found some value in today's video content. Take care.